Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And in this week podcast, I'm going to take you through the why the bond risk rises when money conditions are tight. And money conditions are extremely tight now and becoming tighter. So what I mean by money conditions are tight and becoming tighter means that when the availability of funds for borrowers is getting expensive, and because there are too many borrowers and there is too little of money floating around to satisfy every borrower's needs. And this, in such cases, like in any demand supply situation, when there is more demand for money and supply is limited, the cost of funds rise. And sometimes, if there is no money available itself, and then lenders have to allocate between 10 different borrowers, they will give it to the safest borrower. And even though the safest borrowers will be borrowing at less cost than other borrowers, they will give it to the cheapest, the safest borrower rather than the weakest borrower. And so, hence, bond risk. So, bonds are basically issued by corporates or borrowers who use it as a form of borrowing or form of debt. And these bond risk increases because when bonds come up for redemption, then if a borrower is not able to have enough cash flows to service the redemption, they would have to go and borrow more money from the market to issue of bonds. And one is this bond issue can be very expensive, and the second is that sometimes the investors may not even want to invest in the bonds because they don't have money, or safer borrowers come at a better, more attractive uh, yields or returns. And they would rather take in good returns from safer borrowers than higher returns from weaker borrowers, especially when macroeconomic conditions and also when money is very tight. And so here we are seeing a lot of tightness in the money. Just to give you why the money is tight. Just last year, the system means banks and the whole system had a surplus of close to 7 lakh crores or 7 trillion rupees of surplus. And now it's become negative of around close to rupees 1 lakh crores or 1 trillion. And this is getting more and more. The negative liquidity is going to increase. So 1 lakh crores can become more, and a half, 2 lakh crores, etc. So if this happens, then money becomes very expensive. And when money becomes expensive, then rates go up for borrowers, especially in the shorter tenor bonds. So this gives an opportunity for investors because they can get good bonds at higher returns. When last year for a 1 year bond they were getting 5.5%, now they can get close to 7% or 7.5%. And similarly for 2 to 3 year bonds, so that now they are able to increase their returns on safer investments and on shorter investments. But having said that, investors who have invested in weaker issuers without looking at the credit risk or believing that the risk is pretty safe, then could be seeing extra risk on their investment because the issuer of higher return, higher yielding bonds could be facing issues or trouble in terms of uh, uh, servicing the debt, especially when it comes up for maturity. They have to pay a very high cost, and that could actually increase the risk of the business itself. When money is tight, the risk of bond increases. And here, INR bond has its own rate scale, where one of the primary factors is what is the cost of money and the where it can go forward. And if this is and given this, uh, the INR bonds proprietary rating factors in all these conditions, and financial advisors who are looking for the best investments for their clients with safety, liquidity, and returns. Best place for them is obviously INR bonds partner portal. They just come up, sign up, check all the bonds on offer with curated with curation if required, and the proprietary risk rating, and all the analysis that they need to take an informed investment decision, along with the best and most seamless investment process through the year for their clients. Just coming back to some of the private placements last week, Navi FinServ issued 1 year bond at 9%. JM Financial issued 3 year services, issued 3 year bond at 8.5%. Kotak Mahindra Prime 4 year bond at 8.04%. Bajaj Finance issues 5 year bond at 7.95%. Iran Transport issued 10 year bond at 8.75%. Aditya Birla Housing Finance issues 10 year bond at 8.15%. And Cholamandalam Finance issues perpetual bond at 9.5%. Week, slower market last week, largely because of the Diwali festival holidays. Issuances should start picking up next week with many public debt issues for retail investors on the cards. And watch out for INR bonds, debt IPO listings. And investors can and advisors can seamlessly invest for their investors into the debt IPOs. Download the Quick Invest app for the check the debt IPO listings and invest in the IPOs through the app. Thank you very much for listening in.